Try this question. I'll give you a minute. Now, obviously, 15 days have passed since the premium due date, which means he is still in the grace period. So, the grace period has got affected. Suicide and incontestability are still not affected, because if he pays the premium in the grace period, his policy comes back to force. Reinstatement is not affected because it's not yet lapsed. So, the answer is A, grace period. Try this question. Same question, but with, give you a minute. Obviously, if the policy has lapsed, and even if he reinstates, his suicide and incontestability are affected, because whenever he reinstates, it's going to be fresh. Entire contract status is affected, because when he reinstates, his entire contract is going to change. And smoking status, because if he has started smoking, his smoking status may be affected. So the answer should be B, suicide and incontestability, entire contract, and the smoking status. Try this question. I'll give you 20 seconds. So, if you require additional medical information, the underwriter will ask the attending physician statement. Answer is B. I'll give you 10 seconds to do this. The answer should be A, to check information revealed in the application. Because B, to check the past history and of the client's life insurance applications, they will check it in the MIB. And to check detailed medical records of the client, they would have to ask the attending physician. So the answer is A. Which of the following are duties of the agent with respect to the application process? I'll give you 15 seconds. Obviously, the answer is all of the above. All of these are duties of the agent. Try this, I'll give you 1 minute. So obviously here John had a knee injury and he received workers' compensation payments for it. Now after recovery he started a new business and his income has increased. Now if he applies for more disability insurance than the policy that he has, then obviously the underwriter is going to give him an exclusion because he's got a prior knee injury. Probably the policy will say we will not cover you for the knee. So then the answer is C, a waiver or an exclusion rider. I'll give you half a minute to do this question. I think this question is a simple question. A, there is a mistake, it can be corrected. C, it's a misrepresentation, and D again is a misrepresentation. Whereas B, the client has told the truth. He had cancer at the time of application, but he had not yet been diagnosed with the condition. So he was not aware that he had cancer. So in B, the client has told the truth. The insured has told the truth. So the insurance company cannot contest that. So the answer should be B, B as in Bob. I'll give you a minute to do this. So if we see this case, obviously her death benefit is doubled. 100,000 becomes 200,000 because she had an accidental death benefit rider and she died of an accident. And then she has some loan and interest to be paid, so obviously she'll get less than 200. So the answer should be B, 191,000. B as in Bob. Try this question. I'll give you a minute. All right, this is about misstatement of an age, and we had discussed that when age is misstated or sex is misstated, the benefit can be adjusted. The policy cannot be cancelled. So the answer should be D, D as in David, which says as per the Insurance Act, the insurance company will pay a death benefit. However, it will be an amount that is less than 100,000. It will be an adjusted benefit. So as we discussed this morning, there are the temporary needs and the permanent needs. And for temporary needs, we said a term insurance is ideal. Now, a term insurance, obviously you pay only the cost of insurance really and some policy fee, etc. So there is no cash accumulating in the policy. If you surrender this policy or cancel it, you're going to get no money back. And as we discussed this morning, it's the lowest annual premium amongst all kinds of policies. When you're going to buy a policy, the cheapest policy you can buy is the term. And as I said, the shorter the term, the cheaper it's going to be. It's after all about risk, right? The chances of death. So if the time that you're buying is shorter, the likelihood of you dying in that time is a lot less. But as you age and you go to buy a term insurance policy, your premiums keep increasing with age, and it increases quite rapidly as you grow older. So for this reason, most companies issue a term insurance policy only up to a certain age, beyond which there will be no term insurance coverage. I think for the purpose of this course, we can take it that a term insurance will cover a person maximum to age 80, if you look across the industry. Some companies do cover to age 85, but that's not the point. There are some companies who have only a term policy to age 65. After 65, there's no term policy with them. So in general, there is a cutoff age for a term insurance. It's very good for temporary needs, which are going to fall off, which the risk is going to finish by a certain time. A term insurance policy is a very good policy. You pay the cheapest premium, and once the risk is over, you cancel the policy. But the renewable and convertible option enhances the term insurance. If you have a renewable term insurance, at the end of the term, you can renew it for another term. It's actually automatic renewal. You don't have to renew or anything. It automatically renews. But the premium goes up for the next term. So for example, let's say I buy a 5-year term policy and I'm paying a premium of $100 a month. At the end of 5 years, when it renews, I might have to pay a premium of $175. So as long as I'm willing to pay the $175, my insurance continues. There is no medical or anything for the renewal. So during the 5 years, if I even got cancer, the policy automatically continues. There's no medical. Only thing I have to be willing to pay the higher premium. The convertible option, on the other hand, allows you to convert it to a permanent policy. You can convert a term to a permanent policy. So if I buy a 10-year convertible term, it means any time I can opt and get a permanent policy issued for the same face amount that I have, or less, but not more. So if I've got a 10-year term policy for $500,000 of face amount, I can convert it to a permanent policy for maximum $500,000. There will be no medical for the conversion. That's the advantage. So let's say I bought the policy 10-year term, and after 4 years I want to convert to a permanent insurance. I can convert it. There's going to be no medical for the conversion. But I'll be charged the premium for the product to which I convert at the age at which I convert. So if I convert at age 45 to a universal life, they will charge me whatever premium is charged for that kind of universal life for a 45-year-old person. But I'm guaranteed to get that universal life in spite of my medical conditions. So convertibility again helps. You can convert it to a permanent insurance. You may have convertibility just for flexibility. Just in case some new need crops up and you need a permanent insurance, you can always convert the term. Sometimes a convertible option helps to, for a person who can't afford the higher premiums at this stage. So the best option for him is to buy a convertible term, pay the lower premiums today, and convert it later to a permanent insurance as and when the person can afford it. So a conversion option can be used for such purposes. Sometimes, or always, when you come across a person who cannot estimate his permanent needs at this point. For example, let's say the person is very young, a young couple, let's say. At this stage of life, you can't expect them to have a clear picture of their permanent needs. So what should you be doing? Give them a renewable and convertible term for whatever maximum amount they can afford. So that as and when their permanent needs become clearer, they can convert this term insurance to permanent policies. No medical, they're medically covered. That's the advantage. Now coming to permanent insurances, there is the term to 100 policy. Now the term to 100 policy charges the level premium to age 100. So if I buy a term to 100 policy, I'm going to pay the same premium for the rest of my life. I pay premium only till I turn 100. When I turn 100, if I'm still living, I can stop paying my premiums. But I'm still covered for the rest of my life. Whenever I die, the policy will pay out the death benefit. So the advantage of a term to 100 policy is that it's the lowest premium for any permanent insurance, amongst the permanent insurance. That means compared to the whole life and the universal life. But the disadvantage is there is no cash accumulating in this policy. So if you ever surrender the policy later, you're going to get nothing back. So a term 100 insurance is very good for those needs where you're never going to cancel the policy and you're very unlikely to take any loans or anything against the policy. Essentially, it's good for things like funeral costs and estate needs, because these estate taxes, you're very unlikely to cancel this policy. So a term to 100 is good policy for that, such purposes. The other policies, the permanent policies, the whole life and the universal life, what they do is they create a cash reserve. They take more premiums than are due for your age. And the extra money they're taking from you, they put it into an investment account, a savings account. In the case of the whole life, it's called a policy reserve. In the case of a universal life, it's called the investment account. This extra money that you're paying is invested there. And as this account is growing, the amount of insurance that you require keeps reducing. The net amount at risk to the insurer reduces. So that means your premiums at older age become affordable. That's the idea. Now, the whole life policy is a guaranteed policy, the guaranteed whole life policy. There is another kind of whole life policy which is the adjustable whole life, but we'll talk about it later. Right now, when I'm talking about whole life, I'm talking about the guaranteed whole life policy. In a guaranteed whole life policy, everything is guaranteed. the premiums are guaranteed for life. The cash values are guaranteed, which means when you buy a whole life policy, they give you a cash surrender value table, which will tell you a year of the policy and what is the cash value. And those cash values are guaranteed. And they do not depend upon the market or returns that the insurance company gets. Whatever is promised in the policy will be paid to you. Now, because there is cash in these policies, you can take a loan, as we discussed earlier. You can take a loan against the accumulation in your account. Now, because you can take a loan, if you miss a premium, obviously there is cash in your policy. Your policy need not lapse immediately after the grace period. So these policies come with what is called an automatic premium loan feature. So if a insured misses his premium payment with a whole life policy, immediately the insurance company takes a loan against his cash for the amount of the premium and pays his premium, keeps the policy alive. There is a loan account started, of course. Whatever is being taken as a loan to pay his premium will be entered there and interest charge on that. But the policy itself keeps growing and it's alive. The policy is kept alive, kept in force. Now, whenever the insured starts paying his premium, his policy comes back. However, the loan account remains. It's up to the insured. If he wants to clear the loan, he can clear the loan. If he doesn't clear the loan, when he dies, from the death benefit, they're going to take the loan outstanding, plus interest and other stuff. Now, this automatic premium loan will continue till there is cash in the policy. Once the loan account equals the cash surrender value, there is no more cash in the policy. At that stage, they'll give the insured a 1 month grace period. After that, the policy will lapse. Now, because there is cash value again, they give you two other alternatives. You can go for what is called the reduced paid up insurance. For example, let us say I have a policy and I want to stop paying my premiums today. If I want to stop paying my premiums today, what the insurance company will do is reduce my face amount and say I'm insured for that amount for the rest of my life. It's paid up. So let's say I've got a policy for 500,000 and I want to stop paying my premiums today. The insurance company might say, okay, with the premiums you've paid so far, we can cover you for $300,000. So they will cover me permanent for the reduced amount, the $300,000 for the rest of my life. So I can stop paying my premiums today. That's called the reduced paid up insurance. And then there is what is called the extended term insurance. This option is, if I want this option, what the insurance company will do is surrender the whole life policy, pull out the cash, and use the money in the cash reserve as the single premium to buy me a term policy for the same face amount that I have. So if I have a $500,000 whole life policy, the cash surrender value that is available today will be taken out and used to buy me a term insurance for $500,000. But what is going to vary now is the term. Essentially, there are two things, right? There is the face amount axis and the time axis. Time axis and the cash axis. In the reduced paid up insurance, let's say this was $500,000. In the reduced paid up insurance, they reduce this and keep my insurance permanent. In case of extended term, they keep the insurance at the same level but cover me only for a certain period of time. There are two things that they can play with, the dollar amount or the time. In the extended term, they reduce the time of coverage, but the face amount is maintained. You may wonder why people will go for extended term. There are many reasons. Sometimes a person might be terminally ill. There is no point in his reducing his face amount if he knows that he is likely to die within the period the term insurance covers. So which is good, which is better, all those things we cannot discuss because it will depend case to case, which is the best option. Now, whole life policies come either as a participating policy or a non-participating policy. If it is a participating policy, if the cash reserves calculations show that there is more money than was guaranteed. Say, for example, the policy I have today guarantees me $50,000 if I surrender the policy today. But the insurance company calculations of the policy reserve show a figure of $50,500. That means they made $500 extra in my policy. They don't really do the calculation policy-wise. They do it for the entire reserve for all the whole life policies, and then they apportion it to individual policies. But let us, for our sake, assume that it's done for individual policies. It's a model that's worth it. Now, if my policy has $500 more than what was guaranteed by the insurance company, it means they made $500 more by way of investing or reduced mortality cost or saving on their expenses, whatever is the reason. If it is a participating policy, this excess amount generated is refunded to the insured. It is a refund of excess premium collected, because you can look at it that way. Had the actuary who calculated these reserves, the growth in these reserves, had he known that the figure is going to be $50,500, that means there's going to be $500 extra there, he would have charged $500 less in premium from this insurer. So when they give back this money, excess money, it's called a dividend. It's a policy dividend. Don't confuse it with stock dividends. That's a gross up and credit taxation. This is a refund of premium. And premium is what you pay with after-tax dollars. Therefore, there is no taxation on a policy dividend. It's your own money, after-tax dollars being refunded to you. So when you get a refund, you can take it in different ways. You can take it in cash, which means they send you a check or deposit into your account. You can use it for premium reduction. Say I'm getting a dividend of $500 this year, and my premium for the next year is $2,500. Next year I pay only $2,000. The $500 of premium is used, of dividend is used to cover my premium. 1 and 2 are almost same, right? One, you take the cash and pay the same amount of premium. Other, you don't take the cash and pay less amount of premium. Third option, you can tell the insurer, okay, this $500 that is due to me, you invest it on my behalf. So the insurance company opens a non-exempt account and invests this money. Many companies give you choice of investments. They might give you interest-bearing accounts. They might give you mutual funds, seg funds, whatever. You can put your money there and make it grow. And whatever growth takes place annually in these accounts is taxed. Whereas the policy reserve, the whole life policy or the investment account of a UL, they are tax exempt. That means there's no taxation annually on the growth in these accounts. You can go for a paid up addition. So if I'm getting that $500 dividend, the $500 dividend will be used as a single premium to buy me another participating whole life policy, just like the one I have. So if I'm getting $500 and it can buy me a policy for $1,500 of face amount for my life, $1,500 policy will be placed along with my policy. So my original face amount was $500,000. There is another attached policy to my policy for $1,500. So now my death benefit has become $501,500. In the future, when the big policy issues a dividend, obviously the small policy also will issue a small dividend. Together, whatever dividends are received from both these policies will be used to buy me a new policy. That's those kind of adding on policies to your original policy is called paid up additions. Now, obviously, paid up addition means it's an increasing death benefit option. It's an insurance option. But there's no medical required for issue of these new policies. And the fifth option is the 1-year term addition. If you opt for this, let's say I get this $500 dividend, they place a 1-year term policy along with my policy. So let us say for me, $500 can buy me a policy for $200,000 of face amount, 1-year term. So the $200,000 term insurance will be placed next to my policy. So if I die this year, my benefit will be $700,000. Though that is the case, many companies offer what is called the fifth dividend option, where the face amount of the term insurance will be restricted to the cash value in the policy. So if I have a cash value of 50,000, I can get a term policy only for 50,000, and any balance extra money will be refunded to me in cash. Well, that's the detail. So whole life policies are fully guaranteed. You have a participating policy and a non-participating policy. If it was a non-participating policy and they had made the $500 extra in the reserve, the insurance company gets to keep it. Let's say instead of $50,000 in the reserve that is guaranteed, the insurance company's calculation shows only $45,000 or $49,500, $500 less. Now, in this case, whether it's a non-participating policy or a participating policy, the $500 is borne by the insurance company. So if I surrender my policy today, the insurance company has to pay me $50,000. The $500 they put in from their pockets. So whether it's par or non-par, any lower amount in the reserve is made up by the insurance company. If it is more, if it's a non-participating policy, the money is retained by the insurer. If it is a participating policy, it is refunded to the insured in the form of a dividend. There are 5 ways to take a dividend, and we have discussed them: cash, premium reduction, leave it on deposit with the insurer, paid up additions, or 1-year term additions. The whole life policy is definitely an expensive policy because everything is guaranteed about it. Now, obviously, for giving such guarantees, the insurer needs to be very conservative in his calculations. So insurer is going to use some figure like 5-6% for calculating the returns on the policy reserve. And it's all going to be guaranteed. So the insured's task is only to pay his premiums, that's it, and he has got peace of mind. But to get that peace of mind, his premiums are going to be higher than the other forms of the policy, other kinds of policies. Now, to make it attractive, they came out with what are called adjustable whole life policies. In the adjustable whole life policy, they tied it to some benchmark interest or something, interest rate. Let's say they tied it to the prime rate or some interest rate in the economy. Now, if the interest rate goes up, obviously the insurance company is supposed to have made more money in their reserves than if the interest rate rises above the benchmark. In that case, what the insurance company does is they reduce the premiums the next year, keeping the face amount same. If the interest rate falls below the benchmark, then the premiums are maintained, but the face amount is reduced. That's the normal way. Face amount is reduced. However, if the insured agrees, they may increase the premium and maintain his face amount. So there's nothing guaranteed in an adjustable whole life policy, neither the premium nor the interest nor the face amount. That's called an adjustable whole life. These policies are also called interest rate sensitive products. Coming to the universal life, everything what we discussed about the whole life holds for the universal life, except that it's non-participating. There's no dividends. The policy reserve of a whole life is called the investment account of a universal life. And a universal life is an unbundled product. The investment is different, the insurance is different. So the responsibility for the investment is transferred to the insured. That is, in other words, the insurance company is not going to take any risk on the investment. In the case of the whole life, the whole risk was taken by the insurance company and guaranteed. But in a universal life, there are no guarantees. The insured invests his money, and whatever returns he gets is all his reserve has. So if he invests $10,000 into his UL account and the money drops and becomes $5,000, the loss of $5,000 is the is the insureds. The insurance company does not face any of this risk. Now, the insurance charge itself, the insured is given an option. He can choose the term 100 cost, or that means the level cost through his life that he pays. That means the rate per $1,000 is level. Or he chooses the yearly renewable term concept, where his rate per $1,000 increases with age. The choice is usually left to the insured. As a norm, you can take it that for younger people, YRT is okay. For older people, generally you should go for the level, the term 100. Now, the investment account will offer a choice of investments. It offers some guaranteed accounts like interest-bearing accounts, term deposits, and it also offers various mutual funds and other stuff which are not guaranteed. So it is up to the insured to invest his money where he wants. The decision is the insured's. The whole life, just like the whole life policy, the UL policy also can be used to take a loan. If you have cash in a UL reserve, in a UL investment account, you can go and take a loan. Now, in a whole life policy, you can't make a withdrawal. You can take a loan. But in a UL account, you can go withdraw money if you want. You need not take a loan. You can make a withdrawal. But if you make a withdrawal, the value in your account reduces. And the growth, proportional growth in the withdrawal amount will be taxed. UL also offers another flexibility. It offers 4 choices of death benefits. It offers the level death benefit. So let us say this is the UL account, investment account, and this is the insurance policy. Let's say the insurance is for $300,000. Investment account holds $50,000 today, and through his life the person has put in $150,000 as premiums into the account. Now, if he dies and he has chosen the level death benefit option, the beneficiary will receive, in case of level death benefit, the beneficiary will receive $300,000, the face amount of the policy. If the beneficiary has chosen level plus account value, the beneficiary will receive $300,000 plus the $50,000. That means $350,000. The insured could have chosen an indexed option. If he has indexed his death benefit, that means every year the death benefit increases by an index. Most insurance companies will allow you to choose an index between 1 and 8%. So let's say the index is 1% per year. 1% per year index, and he dies 20 years after the policy was issued. Really, it will be 1.01 to the power of 20. That is the increase. But let's just take it as 1% per year as 20%, just for simplicity here. So 20% increase in his death benefit. So if it is indexed at 1% per year, he would have received a benefit of $360,000, 20% increase. Fourth option is level death benefit plus accumulated premium. If he had chosen this option, his beneficiary will receive $300,000 plus the $150,000 that he paid in premium. He will get $450,000 as death benefit. Now, obviously, the premiums that are going to be charged are going to depend upon the option. The only conclusion we can draw is the cheapest premium is going to be for the level death benefit option. The other three, it's going to vary. It depends which one is more, which one is less. Now, as we discussed, the policy reserve or the investment account of any of these policies is tax exempt. You don't pay taxes. Now, because of that, it is possible for some person to take a UL account and dump money into it just to avoid taxes, because it's not taxed. If he needs money, he can take a loan and pay some interest charges, not the amount that you would pay if you had paid in taxes. So people started using universal life when it was introduced for such purposes as a tax shelter, and the government started losing on taxes. So in December 82, the government came out with new laws that limited the amount of money that you can have in a policy. So for this, they defined what is called the maximum tax actuarial reserve. That means how much money can you have in your account. And they defined it as the amount that would be there in a 20-pay endowment at 85 policy. Doesn't matter, just assume it's a standard policy which is growing every year. Every year at your policy's anniversary, your policy is compared with the standard policy. If your policy has less than or equal to the MTAR, your policy is fine, it's tax exempt. But if your policy has more money than the MTAR, it becomes non-exempt. When it becomes non-exempt, they give you 60 days time to rectify the problem. The most standard way of rectifying the problem is to pull out the excess money and pay tax. Now, if you're not interested in that, the other way is to increase your face amount and get a new MTAR and hope that your balance is less than that. If this problem is not rectified in 60 days, the policy is declared non-exempt for life, which means in that year, when it's declared non-exempt for life, the entire policy gain will have to be included in income and taxes paid. And thereafter, any growth that takes place will be taxed annually. Now, supplementary benefits and riders that you can add on to a policy. We have the accidental death and dismemberment riders. Accidental death rider doubles your death benefit. A dismemberment rider will pay you some lump sum if you lose any two limbs, sight, speech or hearing. Now, for a death to be considered accidental, remember death must occur within 365 days of the accident. The waiver of premium riders, these riders basically help if the insured is disabled and cannot pay his premiums. The insurance company pays his premium during his disability period. Normally it comes with a waiting period. The insured continues to pay his premium during the waiting period. And if he is still disabled beyond the waiting period, the insurance company starts paying his premium. And in some cases, they might retroactively pay back any premium that he paid during the waiting period. So, if you look at these waiver of premium riders, there are what are called the waiver of premium riders, which are applicable to two-party contracts, where the insured is also the life insured. But if you are in a three-party contract, let's say I own a policy on the life of my son. I am the payer. My son is the life insured. If my son gets disabled, it doesn't affect the premium payment. The premium payment is affected if I am disabled. In that case, I need to buy what is called the payer disability. That means I got to insure myself for disability, at least for the extent of the premium. That's called the payer disability. It's a waiver of premium applied to the insured instead of the life insured. And then there is what is called the parent waiver. A parent waiver holds when the parent insures a minor child. And if the parent dies while the child is still a minor, the insurance company keeps paying the premium to a predetermined age, normally age 21 or 25, at which time they will give a choice to the child, who is now an adult, to decide whether he or she wants to continue the policy. Then there are what are called accelerated death benefit riders. These riders pay out a portion of the death benefit when the life insured is alive. These are the terminal illness benefit rider. If the life insured is diagnosed with a terminal illness, which means the certification must be available that the life expectancy of this person is 12 years or less, 12 months or less, 12 months. So if this person is going to live for less than 12 months, as per the doctors, then they might release up to 50% of his death benefit when he is living. The dread disease rider lists a set of diseases, usually stroke, cancer, heart attack, those kind of major things. And if the insured is diagnosed with one of those conditions, it pays a certain lump sum out of his death benefit to him when he is living. And the balance will be paid to the beneficiary. The long-term care insurance rider, this rider will pay a benefit to the insured if the insured needs to go to a long-term care facility. Let's say it's $100 a day. If the insured goes to a long-term care facility, every day he spends in the long-term care facility, the insurance company will pay $100. Every time they pay out the $100, the death benefit is reduced by $100. We have term insurance riders. These are riders that you can add on to a permanent policy. So let's say you have a whole life policy for $500,000 and you get a new kind of debt or something, say a mortgage, and you want to cover yourself for the mortgage. You got two options. You can go buy a separate term insurance policy, or you can add it as a rider to the whole life policy. It's the same thing really, because in both cases you have to do medical, whether you add it as a rider or you buy a new policy. It's a matter of choice. Some people like to keep things in one place, and the insurance company wants those people to buy the term insurance from them. So they offer these riders. Child life insurance riders, these riders insure children along with the parents' policy. So if I buy a policy for my children, a child term rider, my children will be covered for some fixed amounts like $10,000 or $15,000 each. So if any one of them dies, I will receive $10,000 or $15,000. But the point about adding this rider is, if a new child is born to the family, the new child is automatically covered from the 15th day. And this coverage will continue till either age 21 or 25, depending upon the policy. And the child will have a right to convert this rider into his or her own individual policy. Normally the rider might say, for example, this child can convert it to an individual policy of $100,000. So even if the child has some medical problems, the child will be guaranteed to get this by converting. And we have the guaranteed insurability benefit rider. This rider, if it is added on to a policy, will allow the insured to increase his benefit without a medical. You're going to keep paying extra for this when you add it on to protect you medically. So even if you got cancer, if you have a GIB rider, you can increase your benefit to the extent the GIB rider allows you to increase it. It's a good rider, especially for younger people whose income is expected to increase, as well as for people who know that they have a family history and they're likely to get into some trouble. Say, for example, the client has a family history where his parents and siblings have all got diabetes by the time they're 35. And let's say he's 29 today. It's reasonably certain that he is likely to get diabetes by the time he's 35. His best option would be to buy a policy to the extent he can and add a guaranteed insurability benefit rider. Even if he gets diabetes and later he wants to increase his benefit, he will be allowed to increase it by the guaranteed insurability benefit. Try this question. I'll give you a minute and a half. So as I told you, the correct approach to answer this question would be to read the main question first. Which of the following product solutions are best for Lee and Flora to deal with the capital gains that will be due when he inherits the estate? Now, if you look at capital gains, it's an estate tax problem. You know that a permanent insurance is required. So D can be knocked off. D for David, renewable term insurance cannot be the solution. So the answer has to be A, B, or C, whole life, or universal life, permanent policies. Now, one way to differentiate is the amount of insurance. One is saying 1 million, 1.4, and 250,000. You've got to decide which is the right one. Now, if you read the first paragraph of the story, it tells you that they own a condo and a cottage. The condo may be considered the principal residence, which means they have to pay capital gains tax on the cottage. What is the capital gain in the cottage? It's $1 million, because the ACB is 350,000 and the fair market value is 1.35 million. So $1 million is the capital gain. If $1 million is the capital gain, what is the taxable capital gain? 500,000. So they are likely to pay a tax of maximum $250,000, 50% marginal tax rate. So the answer should be C. Try this question. I'll give you a minute. All right. If we analyze here, what is the need? Denise wants to leave money for her son and husband, which means it's a permanent insurance. If it's permanent insurance, obviously the answer can be A or B for sure. And in a funny way, it could be C. You can buy the renewable and convertible initially and then convert it later to permanent insurance. D obviously is a distract, a critical illness. That's not the answer. A, B, or C are all three possible answers. What is the question directing you to select? the question is directing you to select the most cost efficient solution. Now, you got to be careful here. Cost efficient doesn't mean what is cheapest today. Cost efficient means on which policy are you likely to pay the least premium through the life of the policy. The cheapest option today would obviously be C, renewable and convertible term. But if you buy the cheap policy today and later try to convert to a permanent, you'll be paying higher premium for the permanent policy because you're older. So the most cost efficient solution is the term to 100 policy, A, the term to 100 insurance. Try this question. I'll give you a minute. So again, here, if you look at this question, it is question of identifying what is the need. If you read carefully here, you'll see that Matthew wants to use this policy to cover his mortgage. But if he's managed to clear his mortgage, he wants to leave a guaranteed death benefit to his children. He wants a guaranteed death benefit to the children, which means he's trying to use this policy with dual purpose. If he dies before the mortgage is cleared, he wants the policy to pay out the mortgage. And the balance will obviously go to the children. But if he does not die and the mortgage is cleared, he still wants to leave a guaranteed death benefit to his children. Which means he is looking for a permanent policy. So answer A, which normally should have been used to cover the mortgage, is not the answer for this question. Answer could be B, C or D. All three are possible, permanent insurances. Now after you have identified the possible solutions, look for the criterion given in the question for selection. What is the selection criterion in the question? It says the lowest annual premium possible. So the lowest annual premium possible is only for the term to 100 policy of the possible solutions. So the answer is B, B for Bob, term 100 insurance. Try this one. I'll give you a minute. All right. Here, obviously, the need is estate taxes, which means he is looking for permanent insurance. The answer can be B or D. A and C knock themselves off. Now, between B and D, which one should you select? The criterion given in the question is he wants some policy where he'll get some money back if he cancels. That means he's looking for a policy with cash value. So the answer is D, whole life insurance. I'll give you a minute. the main question is saying, which of the following combinations of life insurance products do you feel is most important, appropriate to solve their short-term needs? Now, the short-term needs indicates that they are interested in some kind of a term insurance. And if you look at the age of the couple, they are only 32 and 31, which means it may not be possible for them to clearly know their permanent requirements at this age. So as an agent, what is your kind of insurance you're supposed to sell them? Renewable and convertible, term. So the best solution in this case is B for Bob, renewable and convertible term insurances. I'll give you a minute. All right, here we see Julie Jackson. She wants to leave money for a child who is disabled. Obviously, she's looking for permanent insurance. If it's permanent insurance, the answer can be A, B, or D. C is knocked off. It's a term insurance. A, B, or D. All three can solve the problem: whole life, term 100, or universal life. But what is the question asking you to select? It is asking for the best combination of policy and rider. So which is the best rider? Whole life policy with term rider. Term rider, she has no requirements. Term 100 with parent waiver. Parent waiver has got no meaning because the mother is insuring herself, not the minor child. So the answer is D, universal life with a waiver of premium. She is a single mother. If she gets disabled, the policy needs to continue. Try this question. I'll give you a minute. This question says his creditors can claim the cash value of the policy only under the following circumstances. We said that it cannot be claimed if he has named an irrevocable beneficiary or a beneficiary of the preferred class. Now 1 says he has named an irrevocable beneficiary. It cannot be claimed. 2 says he has named a beneficiary of the preferred class. Again, it cannot be claimed. 3, he has named the estate, in which case the creditors can claim. He has named his friend as a revocable. It can be claimed. And he has not named any beneficiary. So under circumstance 3, 4, and 5, the creditors can claim the money. So the answer is D. D for David, 3, 4, and 5. To calculate the insurance requirement of the family, say John and Sarah, they are spouses. John makes $8,000 a month and Sarah makes $6,000 a month. Expected monthly expense after John or Sarah's death is $9,000 per month. How much insurance must John have? If you want to calculate the amount of insurance John must have, assume John dies. If John dies, the $8,000 per month income stops. Sarah continues to make the $6,000 per month income. The family expense is $9,000. So Sarah is going to be short of $3,000 per month, which works out to $36,000 per year. That's the cash income shortfall for Sarah. Divide this by the interest rate of 5% given in the question to arrive at $720,000. So if John dies and he provides $720,000 to the family can invest this $720,000 at 5% and earn the $36,000 per year. This is the income need. To this, add the cash need. How do you calculate the cash shortfall? You see in the question, there is assets at death of $250,000 and final expenses of $400,000, which means they are short of $150,000. Add the cash shortfall. So John needs to be insured for $870,000 to provide complete requirements of the family. All you need to do in this case is calculate the income need of the survivors divided by the given interest rate and add the cash shortfall. If there is a cash surplus, subtract it. How much insurance must Sarah carry? The answer is $390,000. Try it out yourself. Try this question. I'll give you a minute. Now in this case, the income requirement of the family is $20,000 per year. Capitalize it, divided by the interest rate of 5% to come to $400,000. And then determine whether there is a cash surplus or a cash shortfall. There are final expenses of $465,000 and assets available of $300,000. So that means they're short of assets of cash of $165,000. Add the cash shortfall. So the answer is D. D for David. Try this question. I'll give you half a minute. Obviously here, if you see the interest rate, you are dividing the income requirement. If the interest rate goes up, the answer comes down. If the interest rate goes down, the amount of insurance shown will be more. It's inversely proportional. Therefore, if the interest rate goes up, the insurance calculation will show less. So the answer is B. B for Bob. Try this question. All right. In this question, I will calculate for John. Okay. John makes 60,000 and Mary makes 40,000. So 100,000 is the total income. They require 70,000 if one of them died, 70%. So they require an income of $70,000, required income. If John dies, Mary makes an income of $40,000. So the shortfall is going to be $30,000. That's what Mary requires per year. You have to capitalize this. If the interest rate is 7%, how much is required? Divided by 7%. It gives you 428,571.42. Let's work with that also. That is what is required for the income need. Now let's try to determine their assets and liabilities. Assets, they have 20,000 saved, and their debts are 150,000 for mortgage and 5,000 for car. So 100,000, 150,000 mortgage, final expenses, 5,000 car, $155,000. That is their final expenses. And funeral expense, they expect 15,000. $170,000 minus assets 20,000. They have a negative balance of $150,000. Plus, they need to leave $100,000 for education of the children. Plus 100 makes it minus $250,000. So if we add this $250,000 here, it becomes 578 sorry, 678,571. Right? Now, of this, he's got insurance, group insurance at work, which covers twice his salary. So he's going to get 678,571.42 minus 120,000. $558,571, which has been rounded there to 559,000. So the answer should be B. Try for Mary yourself. Let's start off with disability insurance. Now, disability insurance is meant to protect an income of a person when he is disabled, cannot go to work. Disability is caused by an accident or an illness, an injury or an illness. Now, the kind of income that the person loses because of a disability, he is going to lose only his active income, earned income. So active income is salary, commissions, net research grants, and net business income. Insurable income for disability purpose does not include rents, investment income, pensions, alimonies, royalties, or any source that continues during disability. Also, if a person has a high percentage of unearned income in his total income mix, it will result in lowering of disability benefit or a decline. They will not give him an insurance. For example, let's say a person has $10,000 coming to him from a trust set up by his grandfather and $2,000 of salary income. Now, if the company is going to cover 60%, he is entitled to $1,200. But the insurance company is going to turn around and ask him, why do you need insurance when you're receiving $10,000 in any case, when you're disabled or not? So they may not give him the insurance. A company will cover a person for a maximum of 60% of his gross income. The income earned per month by the person is as follows. What is his maximum disability eligibility? I'll give you half a minute to do it. Now, his eligible income for disability purpose is the salary 3,000, bonus 1,000, and the net business income 2,000. So he is eligible for $6,000, his part of his eligible income. At 60%, he is eligible for $3,600. That is the maximum disability insurance that he can purchase from this company, $3,600. Now, this, the government rule is a person cannot make more money when he is disabled than what he was making prior to his disability from all disability claims. So they coordinate, because a person who is disabled may be entitled to get benefit from different sources. He may be entitled to get money from his own individual policy, from his group policy, from his at work, from workers' compensation, from Canada pension plan, so many sources. Now, if he is disabled and is getting money from all these sources, he may land up getting more money than what he was making prior to his disability. Now, when this happens, insurance companies are going to reduce the amount of money that the person is eligible to receive. Now, let us say this person who is eligible to buy $3,600 maximum, that's what we calculated here. We'll work with him as the example. He is eligible to buy maximum $3,600 worth of policy. But let us say he buys a policy for $2,000 a month. Let us say he purchases the policy for $2,000 a month. So let us write here his eligibility is $3,600 per month. Policy that he owns, benefit is $2,000 a month. There is a clause called all sources maximum. This clause in a policy is always there. And this clause will state that the maximum amount a person can get when he is disabled from all sources cannot exceed the maximum eligibility. And the maximum eligibility figure will be given as a percentage. All right. So let us assume here that this person gets disabled at work. If you get disabled at work, obviously workers' compensation pays you. So let us say workers' compensation pays him $2,500 a month. Workers' compensation pays him a benefit of $2,500 per month. How much will his policy pay him with the all sources maximum clause? He is eligible to receive $3,600. He is receiving $2,500. So he is still eligible to get $1,100. So his policy will pay him $1,100 only by the all sources maximum clause. So the policy will reduce the benefit of $2,000 that they need to pay, and they will pay him only $1,100. That is by the all sources maximum clause. A policy may have another clause which is called the offset clause. It may be there in a policy, it may not be there, the offset clause. In other words, the all sources maximum clause is generally always there, but an offset clause may or may not be there. The offset clause states that they will deduct from the policy benefit any payment received from certain sources. They list the sources. So let us say the policy that he owns, this $2,000 a month policy, lists Canada Pension Plan and workers' compensation as the sources that they will deduct. If he has an offset clause, let us say he's got an offset, and he's receiving from workers' compensation $2,500. How much will his policy pay him? His policy will deduct what he has received. So in this case, he's got $500 more, so his policy will pay him $0. That's an offset clause. Offset clause will reduce from the benefit. The all sources maximum reduces from the eligibility. Both these are important because they tend to ask you these questions in the provincial. Please understand all sources maximum and offset clauses. Now obviously a policy with an offset clause will be cheaper than a policy without an offset clause. Now total disability, obviously you need to define what is total disability, and it's defined in the industry using three definitions. One is the own policy, own occupation, the regular occupation, and the any occupation. The own occupation policy states that a person is disabled if he is unable to perform the duties of his occupation, important duties. So let us consider here a person, a surgeon, and he has a own occupation policy with a benefit of $5,000 per month. His hand is crushed and he's under treatment for 6 months. During these 6 months, obviously he cannot do surgery, so the policy pays him $5,000 a month. Now his treatment is over and he's left with a deformed hand. If he's got a deformed hand, obviously he cannot do surgery. He's still disabled and he cannot perform surgery, his occupation. So he gets paid $5,000 a month. Now let us say the university offers him a job, or he works as a consultant for some company and receives $3,000 a month. His policy will still continue to pay him $5,000 a month. That's the own occupation policy. If he ever returns to his original occupation and is able to do surgery, the payments will stop. Then there comes the regular occupation policy. This policy states that the person is disabled if he cannot perform important duties of his occupation and he is not employed elsewhere. So if this surgeon has a regular occupation policy and his hand is crushed and he is under treatment for 6 months, he will get benefit for 6 months. The treatment is over and his hand is deformed, he cannot do surgery and he is not employed elsewhere, he will get his $5,000 a month. Let us say he starts working as a consultant and makes $3,000 a month. The regular occupation policy will only pay him the difference. It will pay him $2,000 a month. If he makes $5,000 outside, then the policy will pay him zero. And then there is the any occupation policy, which says the person is disabled only if he cannot perform gainful employment in any occupation for which he is suited by training or education. So if the surgeon has any occupation policy and his hand is crushed and he is under treatment for 6 months, he will get paid for the 6 months. But once the treatment is over and his hand is deformed, he may not be considered disabled because he can perform in some other occupation based on his training and education. So we can see the difference in the three definitions. Obviously, the own occupation policies are the most expensive and the cheapest policies are the any. Now, own occupation policies are really expensive and many companies issue them only to the high-end occupations. Doctors, surgeons, not to anybody. The regular occupation policies are generally available for anybody, and the any occupation policies are ideally suited for skilled and unskilled labor. You then got to choose the benefit period, how long the policy will pay for each disability. Ideally, everybody should have a 2-age-65 policy because it covers you for any kind of disability, short-term, long-term, permanent. However, if people cannot afford the 2-age-65, you can give them lower benefit periods. But the most comprehensive coverage is the 2-age-65 policy because it covers you for your entire working life. Elimination period is the period of time the policy will not pay for each claim. Here in this example, I am showing you a 1-month elimination period. So if the person is disabled, for the first month it will not pay him. From the second month, the benefit period starts. If he recovers within the 1 month, normally no payment will be made. So it will pay only for disabilities that last for more than 1 month. Now every time a person makes a claim, a new elimination period will be applied, a fresh elimination period. Obviously, more the elimination, the bigger, longer the elimination period, lower the premium.